bonds. What are bonds, and how does the Fed cut affect bonds? Let's talk about that. All of that coming back. Stay tuned. Welcome back, guys. How you guys doing out there? So today we're talking about bonds and how bonds are affected by the Fed cuts, and what is a bond and what's the purpose of a bond. So let's take a little deeper look into this, and let me help you guys try to explain what a bond is, so you can have a better idea of what a bond is. So basically, when you buy a bond, you're buying debt. So a bond can be in the form of maybe a company that needs to raise money for either infrastructure, or they need to raise money for studies, or for employment, economic wise, as far as to getting their company better off, or whatever the deal is. This is what a bond is used for in a company. In a government way, it can be used for road fixing. They can use a bond to fix roads, for schooling. It can be used for municipal type of things like that. It's basically what a bond is. So it's government fundings that normally they need help with, and in that prospect, they hope that you buy the bond, so this way they can get the money to fix the roads and do stuff like that, because maybe they just don't have enough money from taxpayers to actually go ahead and get these jobs done. So this is where a bond comes into play. Now, when you buy a bond, you're basically buying debt. So you become the credit holder. So you're the creditor. Okay. So let's say you buy a bond, and the bond is for $500 for an example. Okay. And the bond is going to give you, let's just say the bond is going to give you a year-to-date interest rate on a bond. So let's say the bond is going to give you, let's just be generous, and let's say the bond is going to give you 10%. Okay, so that's 10% out of every 100. So that's $500 at 10%. That's $50 every year. So $50 every year, you're going to receive a coupon for interest for $50 every year until that bond matures. That's if everything stays honky-dory. Okay, so if you hold on to this bond for the course of, let's say, 10 years at $50, then you go ahead and you multiply 50 by 10, and that will give you how much interest you would get on this bond. Now, it's a double bonus in the sense that, okay, now you have the interest for this bond, which you was collecting every year, but now on top of that as well, now you get to sell the bond hopefully for more money than what you actually initially bought it for. So let's say that bond has matured, and now you're able to sell it for, let's say, $700 or $1,000. That's great. That is great. So that means you got your interest off of that, plus you got the initial sale from the bond. That's fantastic. Now, how does a Fed cut affects the bond? So when the Fed cuts comes in and they affect the bonds, it kills that coupon that we're talking about, that interest rate coupon. It kills it. So if the Feds go ahead and they lower interest rate down, then basically the bond starts to lose value, which is not a good thing. It's a travesty. So a lot of the old folks went and bought bonds, or they put money in municipal bonds and stuff like that, because they're going into retirement and they want to go ahead and have a little nest egg, and they figure this is the best way of doing it from their financial advisors and stuff like that. So they figure this is the best and safest way of doing it, because you know what, they don't have time to manage their money, they don't have time to really be looking at their money like that, and this is a kind of like a safe way of making that money grow. That's great and all, but right now your money's in jeopardy. Because you had this week alone, one of the financial advisors, or whatever you want to call these guys, from JP Morgan, calling out that with this new Fed cut, the 10-year bond is going to be at zero.
The timing is very suspect, right? Because the Fed's blackout period is about to start. And so sometimes when they have something in mind, they are a little bit extra forceful in the days before that. So between John Williams and Richard Clarida, those are two of the big three, along with Powell, in terms of Fed speakers. And for them to be saying, we need to act preemptively, we need to act aggressively, when you're close to the zero bound, you need to go hard and go fast. it's starting to get people a little bit concerned that if it will be a 50 basis point cut after all.
And it's interesting, we've been hearing about perhaps the need for shock and awe, or indeed the response of the market to shock and awe that we might see from a 50 basis point cut. In fact, we heard from JP Morgan Asset Management's Bob Michael speaking on Bloomberg earlier today, and we asked him how much he sees lower yields on the US 10-year going. Take a listen.
All the way down to zero.
Wow.
And I think that's where we're headed over the next. One after another are falling into line and cutting rates. We saw it overnight with the Bank of Korea. We've seen it with the Bank of Indonesia. You're going to see it at the end of the month with the Fed. You may see it from the ECB sooner than people expect. And we think at this point in the cycle, you need some shock and awe. So I'm not saying we're going to get there right away, but that's the journey we're on until something different happens.
That is a travesty, guys, to have an interest rate of zero. That means you get no money whatsoever. So you're holding on to a dead weight and you're getting nothing for it. That is a travesty. Now, also the Feds, with this Fed cuts, what they're trying to do is they're trying to balance the fiat. They're trying to balance the US dollar. They're trying to make sure that the US dollar stays strong. So this is the reason why the Feds play with this. Now, when the Feds play around with this Russian roulette like this, the way they play with this Russian roulette, it only means problems. Because with everything going down, that means it's easier to get a loan, it's easier to get a lot of other stuff for a lot of American people out there. And what happens is that there's more money to actually go and get. And we're getting more money, that means there's going to be more debt. So on a growth of moving up, there is debt moving up, which means then you have a lot of problems paying back off on that debt when you fall into a recession. When the Feds try to go ahead and raise back the interest rate on it, and then you wind up with a higher debt that you that you couldn't afford it at the time, or you can't afford it at the time, and now you have to default on these debts. That becomes a problem. That's when you fall into what we see, a recession. So I've been calling out for a recession for the longest. I think I'm one of the first YouTubers out there putting out a video on recessions. Unfortunately, I don't have the fan base that I need to, but it is what it is. It looks like we're going into recession. I have been saying it. I know we're going into recession. Numbers don't lie. And it's just basically the Feds playing with Russian roulette before this happens. They're trying to just play it off. Now, do I believe a recession is going to happen in 3 months from now? No. Do I believe it's going to happen 10 months from now? No. But I do believe that the next recession will happen in the next prime elections. So in the next elections, we're going to see recession showing its ugly head. Now, you guys have to prepare yourself for this, guys. We're going into some rough waters here. All right, and I've been saying it, we're going to go into some rough waters. We have to be ready for this. All right, and for the younger generation out there who are investing in stocks and are making a killing right now, because you know what, the stocks are doing so great, and you know what, they're making so much money. It is crucial that you keep your eyes on your money, and it's even more crucial to start saving a lot more of your money, and don't go so aggressive on a lot of these stocks right now, because when the recession hits, this is perfect for you guys to go ahead and start doing what we call chicken feeding. All right, because basically you'll be able to get any of these companies for a cheaper price, which is fantastic. All right, so just prepare yourself for it. Now, I'm not telling you go sell all your stocks so this way you can have some liquidity on the side, but I'm not saying that. And I'm not saying, you know what, that you should go ahead and get rid of all your bonds, because you know what, all the bonds are now worth nothing. They just crap. That's not what I'm saying either. But what I am saying is this is a time to keep your eyes open. They don't educate the public. They don't give the message out to the public. And they definitely don't want mass hysteria or panic in the public. So this is why it's not being spoken, and this is why it's not being said too much on television, on newspapers, on radio stations. They don't really get into it too much because they don't want to panic the population. But America is going to go into a recession, and this is going to be a bad one. Okay, this is going to be a bad recession with the tariff in play. Okay, this only can just get worse because we're not winning the war on tariff at all. We're not winning the war at all. Okay, and this is causing the consumer more money at the cash register. So this is not going to be a good thing, especially when this boils over and it's just going to be a massive mess. Okay, so for those older people that are holding on to those bonds, I will say to start looking at it a little bit more closer. If you know that you are falling into a bond that's going to lose its interest rate, get rid of it now. That's the best advice I can give to you. Get rid of it now. It's better to lose $100 now than to lose $2,000 down the road. 100 to 2,000, it's a big jump. Okay, so if you need to lose a little bit of money now and reevaluate yourself and gather yourself so this way you can get that money back, I'd rather you do that than to go ahead and lose all your money and wind up in bankruptcy, which is not what I want to see for the older folks. And for the newer generation, what I want to see is opportunity. I want to see you guys save enough money so this way when all of this crap is happening, you can capitalize on it and come out like a fat rat. Okay, the younger generation are getting smarter. They're not as dumb as my generation growing up. They are a lot smarter. So they know that, you know what, they have this, how can I put it, not so much of a good trusting with the government idea. So they know what's going on a little bit better. They educate themselves. They use the internet to get the information that they need. It is your job to make sure that you stay up and current with what's going on with your finances. It's your job. It's not a financial advisor's job to tell you that, you know what, you have to stay current with it when that's something you know you need to do. Okay, you need to stay current with your finances. You need to know what's going on, what's going to happen, and how you be able to protect yourself from it. Because the old generation is not in a situation where they can prepare themselves, in the sense that they don't. A lot of old folks out there that invested in stuff like that are just putting money in mutual funds and stuff like that, don't have gold in their portfolio. And usually when both of these things collapse, the stocks and the bonds, investors run to the harder commodity like gold and silver. And a lot of these old folks, I want to say, don't have gold or silver in their portfolio. And this is a major travesty. Major travesty. Learn to make a portfolio that is so diverse that it will cover your butt in any situation and in any way that is possible. All right, this is for the old folks. I don't want to see you guys go through any more trouble, and I definitely don't want to see another recession bubble that popped when we saw the housing bubble, a recession that popped, and people was just losing their houses left and right and right and left, because again, everything was so low. It was easier to get a mortgage. It was easier to go ahead and just buy money and just make money and make more money, because it was so easy with that. As far as to, when I say buy money in the sense of lending it and then just go ahead and just pay for something and stuff like that, this is coming back again. And if history teaches us anything, is not to fall back in the same hole that you know you got hurt the first time. Avoid that trap by any means necessary. All right, guys? And that's today's message. Again, don't forget, more gains, more gains, more gains. Giving it your... Peace out.